So let's start with no further ado. So hi everyone, and good afternoon, evening, morning, depends where you are in the world at the moment. Here in Miami, it's nice and sunny afternoon in South Florida. And welcome to another webinar in the Lendai webinar series of we hosting industry professionals and giving some input of what's going on in the market, where are the opportunity, what to take more caution when you're looking at. Lendai, as some of you already know, and many of you already working with us, and we're the #1 lender in the US for foreign nationals as a fintech company and a private lender who focus specifically on foreign nationals investing in US residential real estate. And in this webinar, we have the privilege of hosting Daniel Shaked. Daniel is the CEO and the founder of Home 365. I have no other word but revolutionary property management company or asset management company, even to say the least. And Daniel will share with us some of his experience of what they're seeing in the market, how to better align ourselves towards our US investments, and specifically for us out of state or out of country investors, where property management is a crucial part of our managing our real estate business. We'll start with giving Daniel to give a short introduction on himself and the company, and then we'll have some discussion on some interesting topics that we aligned for here. So Daniel, welcome on board, and looking forward to talking to you.
Amazing. Thank you so much, Yair. It's a great pleasure and privilege to be here. And of course, to talk about the property management landscape and how important and crucial property management is for success of any real estate investing. Before we dive into questions and answers and all that, I would like to present briefly who we are, what we are after, and let's see how it goes. Let's take it from there. Let me share my screen.
And just for now we can see your screen. Just one housekeeping task. So any questions that you have a Q&A section in the Zoom. So just write down the questions. We'll try to answer maybe some of them as we speak, or maybe at the end, but we'll make sure to address every question that any one of you will have. So that just for some housekeeping. And Daniel, the floor is yours.
Perfect, amazing. Well, so I'm Daniel. I'm the founder and CEO of Home 365. Founded the company late 2016. My background is in tech since the year of 2000, plus minus. I've been a VP of operations for big corporates like the System, French corporate. I'm a mechanical engineer and MBA by my trade. And for the rest of, I would say, 15 years, I'm dealing with everything around the home services and property management. I live in the San Francisco Bay Area and leading the company with, I would say, scattered site offices, all the way from our research and development center based out of Tel Aviv to two main operational hubs, one in Pennsylvania and one in Nevada, Las Vegas, while we are headquartered in the Silicon Valley. So we are after Home 365 is basically trying to make real estate investing accessible for everyone as an alternative way to make your wealth and passive investment for your future. We are not really seeing ourselves as property managers, but rather than money managers. Our objective here is to make real estate investing accessible for everyone as an alternative way to save for future. Better vehicle than any other savings account you might have, a much better and more yielding vehicle than any 401k or anything that you might think around it. The only challenge here is how do we make it really passive, almost like saving money in whatever account, bank account, without the leaning forward approach, but actually how do we make you lean backwards, invest and rest, and gain more wealth, being very passive while being a landlord without the pain of being a landlord. And that's what we're after. The pains, you probably know that as seasoned investors, or even if you are just into this business right now, you know that managing properties, managing rental businesses is hard, especially if you are managing a couple properties across multiple cities, and it might be very risky and unpredictable in terms of potential costs, horror stories. We can write a book about various horror stories that investors are having with their tenants, all the way through the life cycle of owning a property. So here's that's what we do. We are here to reduce the stress. We will help people to actually build meaningful, best yielding portfolios by helping them buy properties across multiple markets and deploy the money you might have, or actually manage properties for those people who already have properties. But we are here to have a good outlook into different markets. And you will see in a second, we're operating quite a few of them. And tailor to your needs the best yielding portfolio, then manage that portfolio all the way, A to Z, all the way from renting the property up until re-renting it again, going through all the life cycles of finding the tenants, collecting rents, dealing with maintenance and repairs, evictions, delinquencies, vacancies, anything. And the most, I would say, unique thing about what we're doing, side of technology and automation, is that we underwrite the investment risk, meaning we have a very unique business model, not like any other management company that you would see around there. Our business model is pretty much very similar to a quasi-insurance product, where we are actually changing quite a bit of the mindset and paradigms of property management, trying to take it all the way from outside of real estate investing into actually more of a financial asset class. And in order to make it happen, we actually need to think out of the box and introduce a completely different business model, which I will expose and talk about in a second. So the first paradigm, from investing to actually managing money and having people to save more for their future. And the second thing is from property management to money management. That's a different DNA of a company. This is why we have so much synergy with LendAI, being a fintech company. We are the same in a way. We have the privilege right now to manage your money, although it's buried in the format of drywall or bricks. It's still your money, and you are here because you are interested to increase and make your returns better. So that mindset of drifting away from being just a building property manager to money management drives an entirely different DNA of our company, the way our product is built, the way we talk, and the way we act as a company. As you know, the market is unbelievably huge. And I want to mention that out of the 50 million rentals outside there in the United States, we are focusing as a company on the 60% of that market, which are mainly single family homes and small multifamilies, duplexes, fourplexes. We manage properties up to 30 units, call it. That's our sweet spot. But the best sweet spot for us is single family homes. The interesting part of that 60% of the unbelievably huge market of the US real estate is that over 80% are people like yourself, what we call individual investors, mom and pop investors, with an average of couple properties, 2 or more. Around 50% will be remote, not even Americans, international. And you probably know that the best thing or the most important thing for you, aside of profits and returns, is peace of mind, is to know that, hey, you have a reliable partner out there that will take care of your needs. So we are now managing around over 6,000 properties, worth of more than $1 billion worth of assets. We are doing that for over 1,600 owners, which is a big amount of owners. We are in top companies in the United States managing third-party properties in terms of scale and size. We are in 9 states right now, 16 metros. Some of the locations here, like Florida, are marked as if we are there. We are on our way there. We're in the launching processes, but that's who we are. We are backed by very respectful and reputable companies. Some of them are corporate venture capitals, like Verizon, like Samsung, and some other respectful venture capital firms like Viola and other property companies. The idea here, those basically wouldn't back just the property manager. We are disrupting and changing the way property management should be done to make sure that all our investors are actually getting the right returns and the right experience, which is pretty much negative right now, or have a very negative sentiment with the current property management landscape outside there in the United States. A unique part of our business model, the lower bar is what you actually would see on average people paying in order to run the rental business. If you can see here, the lower bar, your kind of operating expenses will be narrowing down on average, I'm talking, to 35 to 40% of your income, paying property manager around 10 to whatever percent. And the maintenance and repairs would actually be a big chunk of your spend of 15%, etc. Vacancies are accounted for at least a month every year. Sometimes might be more, sometimes less. If there is a tenant turnover, numbers might change. You know that certain year might be great, but over a certain period of time, long enough, you will be seeing around 60% or 50% net operating income. Our business model is very unique. You see the pink bar up there? It's like a premium. We are crunching a lot of data around the property itself, the building that you have, and trying to assess and analyze what might be the risks associated with running this rental property as a business going forward. We're trying to predict events around people, like non-payments, like vacancies, like delinquencies, things like that. What type of residents are going to occupy your unit on a very granular level of a neighborhood. But we're also looking at the building itself, doing actual inspection, but also pulling quite a lot of information from various data sources. And we're blending all that information, projecting and predicting various events, like even how many garage doors are not going to open next month in San Francisco, for example. When you have this data around maintenance and repairs events, around evictions and non-payments events, we could build an insurance product around it, where our business model is that we charge a flat rate for a property, and in exchange for that, we are basically guaranteeing a full one line of income regardless of what happens. That means if the tenant is not paying rent, we are paying your rent instead. If there is a vacancy, we are paying your rent during the vacancy time until we are able to list this property. That means that your top line revenue is always the same line revenue as the rent, regardless of various events, as well as on the repairs and maintenance side, on the building coverage aspect, we are taking care of all the repairs, maintenance, tenants, turnovers on our own expense. That's what this premium covers you. One rate protects investors from unexpected events. This is a monthly premium, and as long as this premium is being in place, you can rest easy and know that anything that happens actually is not really part of your business. We're taking care of everything on our own. We are utilizing for that a lot of technology, including people on the ground in every city we're operating. We have local teams. We have bigger teams in two main offices, monitoring everything that happens. But that couldn't happen without the miracle of technology. We have amazingly open and super transparent portals. Our systems are automated, triggering various events and workflows to make it sure that we are super efficient, with no errors, and can do our things as fast as possible with minimum risk to anyone. We are building our own software in-house management systems. We are utilizing an integrated, not even integrated, it's part of who we are, marketplace of thousands of various blue-collar vendors, but not only plumbers and electricians, also lenders, title companies, realtors, and we are conducting quite a bit of that. With that, I'll stop here and we'll dive into the Q&A session.
And so, first of all, thank you, Daniel, for this wonderful introduction. I love the presentation. I think the first time I see the new colors and the new branding. Whoever you and I know, Home 365 just had a rebranding, so all the colors that you're seeing is new colors, and I like that. And you touched a lot of points during this presentation that I want to, take some time to drill down. So one thing that you mentioned, and I'm a true believer in what you said. It's a real estate is not a real estate, it's a business for real estate. And what we see a lot in the market is people saying, no, I'm buying a free real estate investment properties and I'm managing it. I'm looking on every dollar that's coming in, but I don't know exactly how many dollars are coming out. And I don't really know what is my bottom line, I don't know how much money I'm making before taxes, after taxes. And I think that the point that you mentioned, that when people are looking towards investing in the US, they have to see it as a holistic and as an asset class, as you mentioned, and not just, oh, I'm buying four walls and a roof and there's a tenant inside. You're buying a business. And the same way that if you would decide to invest in a shop and selling clothes, you want to know exactly what's the location and what's the kind of inventory that you're going to buy and who will be your clients that will come in and what exactly do they need in order to buy to a shop again and again and again. It's the same with real estate. And I think that your capabilities, and I see it from our side as well, we're doing the underwriting and examining the property properly. As you said, the location, the size, the stage, the age of the systems inside the room, everything that you're doing, allowing the foreign national investors and every investor, but specifically the out-of-state investors, to have more data on their properties so they can make sure that their business is a more successful business. And I'm always saying that, and it's very interesting to see because your point of view and ours, we're different companies, but you're looking at the property because you actually needs to manage it. And as you said, you need to make money only if the property is maintained, because if the property doesn't maintain, you can make your earning. And on our side, we put the majority of the money into the deal. We want to make sure that the deal is working. So the underwriting from our, as a mortgage company, the underwriting from our property management, basically, if those companies are aligned on the same property, for me as a personal real estate investor, I know that I can be professional, I can count on my boots on the ground, but eventually I don't know everything. And sometimes I don't even know what the question that I had to ask and I forgot to ask because I don't know what I don't know. So having third-party providers such as a property manager, a lender that does the due diligence gives a lot of comfort, and I'm happy to see, because I see a lot of property managers and forgive me for saying that, but that's, many said that's the Achilles heel of this industry. You can buy an amazing property that is in a great neighborhood, in a great condition, and in the first year it's perfect. You even sometimes buy it with a tenant, but then as the years go by, and we sometimes manage the property for 5, 10, 20 years because we're building our pension basically out of it, then you see that the property, and again, I don't want to go too much into horror stories, but we saw properties that are not well maintained. Eventually the tenants going out, not coming in, the vacancy rate goes up, the repairs goes up. So I was happy to hear your thoughts on that side, and I really agree with that. But what I do want to see and hear from your experience is, when I'm looking on a US property in any one of those markets, what are the things that you think that for me as an investor out of state are the things that I need to check before I even go into this? Is it just a cap rate decision? Is it a location? Or what are the emphasis based on the data that you have? What do I need to check before I put my money and start investing in the US?
It's an amazing question, Yair, but look, it all boils down to the initial sentences you said. When people are thinking about investing, in real estate, they need to understand that they are not really investing in real estate. They are investing in a rental business, and that means they are buying a business. This house is going to be selling a housing experience to potential people who will be willing to pay for that experience monthly rental fee. So you have to adapt a mindset of the business owner. It should be passive. It shouldn't be like super crazy, but like any business, there are a lot of issues that are happening. You need to market this property. You need to make sure that people are actually want to live there. and the experience living there is going to be good for them to keep on paying. Otherwise, you will end up with quite a lot of turnover, people leaving, delinquencies, not willing to pay. And any issue that happens in any business, it might be a shop, it might be a laundry shop, it might be a car washing thing. Okay, if the operations are not smooth, if the experience for the customers who are our tenants, renters, okay, residents actually, is not smooth, the business will be limping. It will not be a great business, and the returns are not going to be great. So the first thing I would say, look at the, do you have this mindset that you want to keep that business running forward, or you want to squeeze out something that that's currently there? Okay.
Do you want to
And
be
there
a
are different
slumlord
personalities.
or an actual landlord?
Exactly. You can get some business in distress, okay? Buy a company that is in distress. I'm just saying, just to make it like very similar to our world. And then try to squeeze out and milk any possible thing that's there without really a long-term view about how this business is going to run for generations. Because we want to maybe at a certain point move those properties to our kids, right? It's our wealth that we're building generational wealth through the real estate investing. And that's why we are focusing as a company on long-term, call it investment, long-term properties versus short-term management, which is a completely different mindset of hotel experience. Okay. So yeah, the first thing is your mindset. Then the cap rate is actually, what do you know? I mean, it's an historical number, right? It's something that worked for someone else. And the only thing you know right now is the price that you buy this business. But the biggest part of the cap rate is the net operating income divided by the price. So the net operating income is 100% derived out of your actions as business owner, as property owner, and how smoothly you run the day-to-day operations. It's just enough that 1 month of delinquency and some Section 8, I don't know, inspection fail, and you don't get a month or two of income, and you are leveraged to teeth with mortgage, and suddenly you are in default and it becomes a problem. And then there might be crazy war stories of abandonments and other things. So we're saying, look, we here.
I want to ask you another question on that side, because I think that's a very important point. Because when we're looking on an investment property, from your experience, you're managing, as I said, more than 6,000 properties. What are the things that we need to look at? What will make you, as a property manager, say, I'm not going to take this property under my management because it looks like a good investment property or a good business, but it's not going to make the returns? What are the things that will raise the flag for you, and of course for us as investors? And you'll say, I don't want to invest here. And on the other side, if you have any rule of thumbs, you say, okay, this is the numbers that you need to look for in order to make sure that you have enough margin to make money on the long run. So those 2 points I would love to hear your thoughts about.
Yeah. I will answer that, but I'm saying just before that, it's like if you decided to buy a business, but you don't have the CEO, the manager to run this business that you trust, and you know that he will be actually putting all his heart into running this business for you as your extension, because you are remote, you're overseas owner of that business. You need someone local that you trust to run it. It doesn't matter actually for how much you buy this property, because a bad management, bad execution will ruin your whatever price it is. You can buy a restaurant cheap, but if you are not able to get out portions, which people like, and you don't know how to build a menu, and nobody comes and buys your food in this restaurant, it doesn't matter for how much you bought this restaurant. So I would say the most important thing here, to make the short thing, find the manager that you trust in this area. Everything that happens from the point you bought this property, it's up to that company, up to that person. You might be doing it yourself. If you can, if you have the time and bandwidth, that's of course okay, but that's like another thing. So the first thing is find someone who you rely on in a market that you know that you can rely on that specific company. Then for us as a company, we are actually looking at the owner and not at the property. And we are trying to figure out who this type of owner is. Is that, again, a slum landlord personality? Someone that doesn't have even a dollar to make this property kind of working or make this property, I would say, reasonable for people to live in, build memories, raise their kids there, okay? And is it just kind of four walls for someone who is, and we don't care about this, call it experience. So we as a company believe in long-term relationships, and tenants are our clients and customers, your clients and customers, and we are the managers of that ecosystem. So we are trying to figure out who the owners are and what's your mindset, okay? And we will be, we are not always taking all of the owners, but if the owner is willing to work with us and create this great experience environment for renters, it doesn't have to be luxury. Don't get me wrong. It should be fit for the right audience, but there are certain things that you as a business owner should be committed to do in order to make sure that that property actually provides that experience. We're seeing interesting numbers. I'm now, as we speak, in Cincinnati, touring the city. We are expanding to this place right now. And I'm seeing amazing numbers. Here on just in front of my eyes, we have a couple of deals right now. A property, $70,000 generates $1,050 of monthly rent. A property of $6,500 generates $1,000 of rent. Amazing cap rate, right? A property
The question is it not too good to be true?
1,100. Exactly. So look, you are going to take a look at the property itself, and that's what I did yesterday. I spent time with that property manager to drive the city and actually take a look at those properties just to understand how does that work. And actually, you see pretty decent properties, very well maintained, but that's the market. For $100,000, you can get a decent property here that generates around $1,200 to $1,400 of rent. That's very unique. I haven't seen it in many other markets, especially not on the coastals, okay, of the United States. But there are pockets like that, especially in what I call non-branded cities. But it attracts a certain personality, a certain type of tenants. Those tenants that can afford only $1,000 of rent, they will be of a certain financial capability, of a certain demography. Those tenants will have other challenges, which will result probably in more management, more events, more maintenance issues. So it depends on the class of the property you are inclined toward. You go with class A property, cap rates are going to be lower, but there will be much less risk, less volatile. If you go with properties of a lower income, you might have an amazing cap rates like the numbers I've just thrown away, but those might have much higher premiums with us, let's say, or much more out-of-pocket money that you need to invest in order to keep up with those properties in a rentable condition. They are older a bit. They are.
So what do you think is the sweet spot between risk and reward and you know, property value, income, cap rate, from your knowledge and your experience? Where should investors look for? Do we want to go to, do you think more to the $100,000 and less, or $200,000 and up, or somewhere in the middle? Where's the sweet spot that you guys see?
It depends on your personality as a person, okay? There are people who are buying very volatile stock of smaller companies, and there are people who are looking for more stability, okay? I personally invest in properties that generate a minimum of $2,000, but that's me personally, okay? It doesn't have to be like with anyone like that. For a simple reason, a person or a family that can afford $2,000 are of a certain financial stability. In my view, they should have a much nicer home to live in, a much better neighborhood. Cap rates might be lower, but it's much, I would say, it's less volatile in terms of crazy events that might happen with very, very low income or government supported types of employees who on paper might be generating better returns, but in reality, many more incidents. It depends on your personality here. Look, I mean, if you are more into risk, you can buy 10 properties of $60,000 each, or maybe one of $600,000. Eventually, it depends on the numbers that you are looking to gain. A lot of the investors we're talking about, they don't really in the game of NOIs and cap rates. They don't really calculate that. They are trying to diversify their wealth, their cash, into building long-term assets and generational wealth. And for that, I would recommend them to go with more healthy properties. I mean, Class Bs and up. If you are more kind of an operator mindset and you are okay to deal with quite a bit of issues happening, you can go with C, sometimes even C minuses, but that's going to be much more hands-on, will be less of a passive investment. So it depends on what you want to do.
I agree with you, and I can say from my perspective that we are actually putting, the majority of the funds into the transaction and making sure that the DSCR, the debt service coverage of the property itself, not even talking about the investor, will work. We used to do properties from when we started $75,000 and up, and we took it up now. Today the minimum property value is $100,000 if it's a portfolio, but I have to say that what we see on a sweet spot is $150,000, and it can go up into $2 million a property if it's a short-term rental in Florida, of course. But looking towards what you said, the $1,800, $2,000 a month rent, you need, it depends on the market, but $150,000 property to $300,000, and then of course depends how stable you want it. You can buy it in Georgia, and we had some deals that we financed in Covington in Georgia. The rent is around the $2,000, but the property worth $300,000. So the cap rates are by definition lower, but it's a new build property, and it will be the same cap rate for the next 10 years or 15 years. In other place, on the paper, it's $100,000 property in Ohio, as you said. It looks like an amazing property, and the examples that you gave, crazy cap rate. But eventually, if it's not managed properly, and it's much harder to manage,
exactly,
the bottom line is much less than it seems. So from what we see, it's interesting that your sweet spot, that what you're seeing, the property is that 150 to 250 with around $200,000 a month. That's what we see on the financing side when we examine the property, the most stable properties. So for us, it's easier to give the money to those properties because we know that the property is going to maintain the debt service and the mortgage will be paid off regularly. So it's interesting to see, because we see a lot of we see Israeli investors that love Ohio, and we see Canadians that invest in Michigan a lot of times, and they're looking for those lower entry point to the market, which is good for as I say, it's either when you're very in the beginning and you want to learn more, so maybe try that and then do all the mistakes on.
And you learn the hard time.
Yeah, you learn the hard way, but you did a mistake on a $50,000. Or when you're very big and you can buy, tens of properties, 20, 30, 40 properties in those areas, and then you have, the safety in numbers. But in the middle, which is the average Joe, as I said, all 2-3 properties in top, I would recommend to go somewhere in the middle where the properties are a bit more stable, and the cap rates are a bit lower sometimes, but the end game is pretty much the same eventually on the long run, because you have the low value property don't have appreciation and other things that we see in the market.
I agree with you 100%. Look, I think the sweet spot is around $200,000, and even if you need you don't have the down, if you don't have the full amount, this is why you have Lend-I, and eventually the cap rates, it's a tricky game. A better management company can make the cap rates much better, and minimize potential issues, and then the entire investment looks much more amazing than it was initially on the paper, trying to project as a rule of thumbs various events that might be completely different. I also think that you need to think like a business owner again. Who is your target audience? And figure out that people can afford around 30% max of their income to housing. So if you rent something for $1,000, most probably those people are making max $3,000 a month. This will put you into a certain demography. And with that demography, there are various associated risks. Okay. And if you are aiming for $2,000, then it's like a much higher demography, which is more suitable for the average, call it blue collar employee in America. It's probably not an hourly wage employee, which is around less than $1,000 probably that can afford a property. It's more of a blue collar worker, might be a teacher, might be a policeman, or people of that kind. It's a different level, I would say, of risk, and depends on your risk appetite. But definitely consider your audience, do your diligence, numbers that you are seeing and various sellers are throwing at you, or companies, like the numbers I just threw out, those are, I would say, theoretical numbers. Eventually, life of experienced investor might look completely different than that. And the question is how volatile, what's appetite and stamina you have for this volatility that might happen.
And that's very interesting. And so just to understand the technicalities of things, so when I'm an investor, I'm looking to buy a property in the US. Of course, I need, you know, a realtor to find me the property, and then I need the property manager, and of course the lender, the full team that will bring me everything on the board. When does the investors meet you? They buy the property and then come to you, or you can also help them find the property, locate the property according to what they need. Do you also help on that side?
Yeah, look, we are licensed real estate brokers in all 9 states that we operate. We have a network of around 50 real estate agents in all those locations that are under our license, constantly looking and scouting for deals to feed our network of 1,600 investors. They are constantly looking to buy more. They are looking to actually increase their portfolios. Some look to liquidate and buy others. So yes, we are helping people to find the right properties, build them the right portfolios, might be across multiple sites or in a certain place. Diversification also goes along with different cities. So we might offer someone, based on the risk profile, to buy one property in Atlanta, one property in call it Pittsburgh, and one property in Vegas. Okay, altogether will be 3 properties which are optimized for the best result, custom tailored fit to the stamina and personality of a potential investor. From that point on, we'll see, we'll basically know the budgets. We already know the properties. Those properties are already coming with one rate and our management included. So you can actually have a good pro forma of pretty predictable P&L going forward, profit and loss statement. And at that point, what you need to do if you need a mortgage or you want to refinance is actually be referred to our partners here and conclude this transaction. We will take care of everything with our real estate agent, A to Z. Titles, working on the all the forms and everything. And from the point you close on this transaction, we are already switching our hat into management company. And then we manage that alongside the underwriting we've done. We are usually intimately, I mean, property is probably already inspected at that time. And we know what we're stepping into. It should be very.
So you're given a full suite solution, and that's good to know, because if it's not just if someone already owns the property, they can also get your help, or if they already find the property with someone else, they can use your services. That's very important. Another thing that I want to pick your brain about, because we've seen a lot of changes in the U.S. real estate market in the last year or so. COVID, interest rate, everything is changing in front of our eyes. As of today, with the data that you have in front of your eyes, where do you see the best markets that are still, performing, even getting, property values are keep on going up, rents are going up, because you have a lot of access to data that the average Joe doesn't have. You see the actual rents, you see the actual vacancy rates, of course, property values, because you also have a real estate brokerage. So can you point us to 1 or 2 or 3 top markets that you're seeing that are still outperforming the market these days?
Yeah, so look, definitely, as the mortgage rates are kind of going up a bit, it actually doesn't concern us much, because it allows us to, investors who are trying to protect themselves from the inflation by buying assets and actually protect themselves with a long-term 30 years mortgage, which is a great way to protect yourself from inflation, is by diversifying cash into assets. We're seeing rents are climbing up with that inflation, even above. They're always a little bit behind from the prices of the properties. Now, if you buy a property at around $200,000, those properties are actually not going down. Their prices are the same. They're pretty stable. Mainly the properties, more
Still now,
luxurious
you still see
properties,
them
I would say.
stable.
Stable, yeah, pretty much stable, even going up. You know what? Even going up slightly, okay? But they are stable. This is like an entry-level asset class. Where can it go? How down can it go? I mean, doesn't make any sense. And the rents are kind of catching up with time. So even if you took a mortgage with much or a little bit higher percent than what it used to be a year ago, or definitely higher, it still will catch up during with the next year rent or with this year rent. And eventually, I had the chance to meet people who invested in the beginning of 2000s with around 20% of interest. In the 90s, I mean, and they are super happy doing that. Eventually, it balances. And just a slightly event or the prevention of a slightly event can change the bottom line of your gross profit considerably. The mortgage is a big thing, the inflation is a big thing, but it's not the only thing that impacts your bottom line. So one of the markets that I'm kind of looking at right now, or as a concept, I would say, the non-branded cities, not the tier one kind of cities that everyone knows how to pronounce and write, have the biggest potential. There are still cities of 1 million people, kind of metros, which is enough people there, maybe even slightly less, but decent metros. And the numbers there are actually well into 8%, sometimes even higher, which is, even with the current mortgage rate, still makes sense. One of those markets that I can tell you that I'm personally following and invested in is it's Pittsburgh market. It's Pennsylvania, right? But it's not the first city that comes into your mind. Hey, let's invest there, right?
Which
You wanted
city?
to
In which country the
Pittsburgh,
state is? Pittsburgh.
Pennsylvania, Pittsburgh,
Yeah.
Pennsylvania. I mean, just for example, it's decent. There are a couple of corporate America companies headquartered there. There's a couple of decent universities, Carnegie Mellon. There's an NFL team. There is an NBA, a baseball team there. It means that it's a decent city, right? But it's not the first city many people would go there right away. People will go to Atlanta, will go to Miami, will go to other branded cities.
Yeah,
So
I
I
think
would
that
suggest,
this is a very good tip there. Don't look on, we as foreign nationals, we don't know every city. There are 3,200 different counties and multiple cities everywhere. And we go to the places we know. We go to Miami, we go to Atlanta, we go to the big names, New York, San
Las
Francisco.
Vegas, yeah.
Exactly. But the money is not always there. The money is those secret pockets that the locals know, that Pittsburgh or any other non-branded, as you call them. I really like this framing. And I think that for us as investors, looking outside of just the main metropolises, there's a lot of room to grow there. And I know the first deals that we made, the first financing that we did years ago was in a city called Augusta, Georgia. It's 3 hours drive from Atlanta. Nobody knows it, but actually there's a big army base there. There's 6 hospitals, and there's always a demand for new rentals. And you can buy a property in this city. You can buy property from a few tens of thousands to a few millions, because they also have one of the best golf courses in the city. But if you're not an American that knows the golf industry, or you're not an army brat that knows the military bases, you would never hear about Augusta, Georgia. That's a great place to invest. We did a lot of loans over there. So I agree with that. And it's not a big city, but there's great returns on investment there. So that's
right. But how do you get it? Right. But how do you get an insight into those secondary market, call it, okay, without having someone local or having an initial interest to explore a certain market? So this is where I suggest to talk with nationwide companies. We might be one of those, or any other company that has a good insight into different cities, different industries, different states. There are laws in states which are different on many levels, especially regarding the landlordship law. Okay. It has to do with taxes, of course. Property taxes are different, but also how easy is the property to evict someone that doesn't pay rent. I mean, the state, how easy it is when something like that happens. And it's a nightmare in certain cities, I can tell you. We're operating in the cities of Chicago and Detroit. Well, average eviction in Detroit takes around 7 months, while on some of the southern states, it might take a month. and we have a new tenant already in place. There are a lot of different considerations to look at there. Numbers might work better in each one of them. But definitely, the more you go into branded cities, the bigger the competition is, the higher the competition is. When you choose the secondary markets, this is where the opportunities are. And don't be afraid of those, because, at least in our Israeli kind of mindset, we grew up in a small country. For us, if it's not the top city, it's probably a very small one. But a small one in the United States is like the entire population of Israel, pretty much. So, I mean, it's completely different scale and completely different mindset adoption there.
Yeah, no, that's a great point. And so again, as I said, look on the not traditional markets, not the first names that comes to your head, and look on those markets. Find the companies that work in those markets, and understand exactly who are your clientele. As you said, understand if I'm going to rent a property in $1,000, what does it mean on my tenant? If I'm going to rent the property in $3,000, what does it mean on the family that's going to live in this household? So I think that that's a very good way of looking into things, and not just, okay, I need the numbers to work. I want to put $100,000 or $1 million, and I want to get X returns. What actually does it mean? The family that's going to live there,
right?
You said, if they make an X amount of money, that means that that's probably 30% of their income. That's mean that they are white collar or blue collar, depends on, of course, how much they pay. And that gives you more stability and say, okay, I know that the teacher will always have a job. I know that, the nurse will always have a job. So it's more stable income. So it means that my revenues will be more stable. And I think that's a very good point of view. We have a question here before we need to start wrapping up. So we'll take a few questions from the crowd. So the question is, you spoke about real estate business, like any business there out there, and there's risk. So what are the top risks that a foreign investor should look when investing in a real estate in the US, and what are the risks regards to property manager? I need to choose a property manager. Maybe I'm working in a market at Home 365 or working, maybe not. Maybe I'm now investing somewhere else. What are the questions that I need to ask before I choose a property manager?
Look, it's very hard. It's like interviewing a CEO to run your other business, okay? A lot of considerations, all the way from the personality of the people that are going to work with you. Don't talk only to the sales guy. I mean, you might want to also speak to someone who is going to operate your property as a property manager, someone that's going to be your account manager, your go-to person for day-to-day issues. Okay, so it's just well above the sales pitch. It's also to get to know the real people that are going to put their hands and legs and heart into your business. So get to know those guys as well. Definitely references. It's like obviously references, but also try to understand if they are operating a local, non-scalable mom and pop kind of shop, because there is a limit to their capacity. They're not flexible enough to give you, maybe as a small investor with 1 unit or 2 units, the attention they will be giving a bigger investor with 50. Okay, and usually those will be, as I mentioned before, there are like 32,000 of them registered in the United States. Most of them are managing around 300, 400 units. There is so much they can do. One of the things that I encourage you to think about, usually you will be paying 8 to 10% to property manager out of an average rent, let's say $1,000. Let's make it a simple number, okay? It's going to be around $100 that you pay those people for a contingent work that they will be doing, while they are paid only when you collect the rents. Now, how much management do you think can a company do for $100? It's like 3 hours of a very low paid employee, $27 an hour or so, like an Uber driver pretty much. Would you give your $500,000 portfolio property to an Uber driver to take a look at it 3 hours a month? That's pretty much the mindset. So what I would offer and suggest, don't try to optimize your business by paying the salary to your CEO. Okay, your CEOs, your managers shouldn't be starving, shouldn't shouldn't be those people that will immediately prioritize you over someone else who might be more generous the way they pay. Saving a couple dollars on management fee, I would say it's not the right idea. It drives cheap managers, non-skilled managers. This is why this entire industry has so negative sentiment. We think that this is a place to cut corners. It's like you wouldn't pay your employee the lowest possible salary. You want to pay for talent. You want to pay for results. You want to maybe even throw in a bonus. Again, I'm talking about some unconventional thinking. But look, if I had to give keys to my $1 million property or $500,000 property to someone, I want to know that this someone is actually putting all his heart in my business. It's a lot of money that I'm trusting someone I don't know. And when you are a remote person, you need to establish a lot of, I would say, clarity with those people. Traditional management companies don't have enough technology to reflect in a very transparent way everything that they're doing. You might be getting a P&L report on a PDF once a month, but that's not enough. You don't know what's the quality of service they're providing the tenant, and then boom, the tenant leaves. Doesn't renew the contract. You don't know really why. When a tenant doesn't renew a contract, it's a hit in your pocket. You need to invest in turning this property, painting it, repairing it, leasing it again, paying all the fees associated with releasing. So your mindset should be a happy tenant as well. So a company that shows everything in a transparent way through their technologies and portals will actually create this trust that they're managing your money in a good way.
So I would take it, just to answer our question, we have a few more, to the other side. So if a company is not transparent with you, you can find good references on them. If they don't have a system that you can easily utilize to see what's going on with your property, not just on your financial, but in general, what's going on in the property, those are the red flags that you need to take care of. Daniel also touched here, the economy of scale. Companies that are bigger can manage more properties at the same time, and companies that are mom-and-pop shops, they might be good for at the beginning, but then when they start to scale, not every company knows how to scale right. And by definition, maybe one big client that have 10 properties will be their VIP, and you with your 2-3 properties will be just another one down the line. So the economy of scale also something to be aware of. We have a few more questions here. If I have a property management company, and I'm not happy with them, when is the right time to switch? In the middle of a contract, at the end, when is the time? Do I need to wait to make sure that they manage my property, or what are your thoughts on that? When should I switch if I'm not happy?
So look, yeah, usually if you are not happy and you had a couple of conversations with them and gave them the heads up, and you tried to work it out with them, and you are still not happy, I would say any time is a good time, unless you have a lot of termination fees. There are some companies we've seen with a lot of termination fees practices. In some point, we help our clients when they switch to us to buy some of that termination fee. We absorb it as part of our, call it, marketing costs. But it depends. It depends on your contract. But I would say don't compromise. It's like keeping a bad employee in your company or in your business that you don't trust, and you trust them with a lot of money, guys. Look, I mean, it's not $50,000 property. It's a lot of money that you give to those people. I'm always teaching our team, when we get a new client, it's not that we sold them $100 per month product or $200 per month product. We actually created this trust, or gained this trust, of getting the keys to their $500,000 property or more, and do with it whatever we deem appropriate to generate them more profits. It's the highest level of trust with money.
Yeah. So I think that in this answer, you actually raised another red flag that we should take care when we're signing on a contract with a property manager, to see if there's any, too big of fees if we want to get out of the agreement. So if I want to terminate what's it? Not just, okay, this is how much they take me on a monthly base, but how can I terminate this agreement? If this agreement is, I'm bound for it for 2 years, or I need to pay a lot of money to get out, that's a red flag. Say, if somebody's doing his job properly, he shouldn't be so afraid that I will leave him, because he will know that he's doing the good job. So it's if somebody's asking you, as Daniel said, too much money, or doing an agreement that there's no exit point out of it, those are red flags and those are risks that you should take into consideration.
I would just disclaim it with one thing. This is the unique industry. I mean, the traditional property management. When people are paid, I mean, managers are paid only when the owner is making money. So they are actually doing a lot of work on a contingent basis. The protections they might have is to recoup the effort of what they've done. Okay. It might take, sometimes they might not be paid for 7 months trying to evict a non-paying tenant and then leasing the property, turning the property. They need to get that money. So those provisions are sometimes healthy and I mean, build the healthy relationship. So you are right, but not always. Okay.
Like anything in real estate, every case and
Yeah,
every deal
right.
should be underwritten accordingly. We have another question here from Alina that says that you mentioned that you also have a real estate brokerage firm and you locate investment properties. So the question is, are there, MLS published properties, or you have also under market value, off market deals that you can show to your clients?
We do have quite a lot of off market, and we also have MLS. We add on top of them our management and the underwriting component to make it more kind of clear and predictable for the investors to predict what's going to happen without really having various rules of thumb. We are getting quite a bit of off-market deals. We have a decent department that is tailoring partnerships with wholesalers, turnkey providers, and a lot of those properties are actually getting marketed to our investors first. But those are like very fast transactions, sometimes in hours. If there is a good deal, it's being kidnapped like right away. So yeah, we do have them. In many cases, it just goes out through emails, through our distros, not even getting to our website. On our website, we have properties which are also different. You will see properties with 8%, 8.5%. So browse them. We are constantly updating those properties there. So both types. We have, like, as I said, around 50 people that are constantly driving business.
That's good to know. So finding off market, under property value, under market value properties, then buy them, renovate them, do whatever needed to be done if needed, and get them running as a nest class. So we don't have any more questions, and we're just exactly on 1 hour, so we're just on time. So I want to take this opportunity to thank you, Daniel, for sharing your vast experience of managing thousands and thousands of properties across multiple states in the US, working from investors from Israel, Europe, Latin America, Canada, basically the same client base as Landai do. And we're always happy. I can say from our side, when an investor comes to us, one of the questions that we always ask is, who's your property manager? And we actually do a due diligence on the property manager as part of our underwriting of the deal, because we know that we work with foreign investors, so they are out of state. So we want to know who's the property manager, how many property they manage, what are their fees. We review their property management agreement, because we want to make sure that the property that we finance will be properly maintained. Because if it's properly maintained, as we said, the business is working and we will get our debt service coverage back. So property manager is one of the main things that we examine. We do appraisal, we do title, and we actually go very deeply into the property manager to make sure that it's proper. For us, a good property manager is another risk mitigation level that takes the risk down. And that's what we love to finance property that managed by Home 365, because we know the stable returns will be there, so we can finance them.
Yeah. As we joke, you are actually, we're thinking of you as a mortgage lender, but you are not. You're a business lender. You are lending money to run businesses for other people so they can scale more, refinance, build bigger portfolios of business. It's a business loan per se.
I 100% agree, and that's how we underwrite the properties. We underwrite them as businesses and business owners, and it's actually called legally, we call it mortgage, but it's actually business purpose loans, because it's actually making sure that somebody can build a real estate business in the US. So I'm 100% agree with you. We have a question. What is the best way to contact you? So you personally or Home 365, if somebody want to ask follow-up questions, we will.
Yep.
What is the best way to contact you then?
So my email is daniel@home365.co. That's also our domain. Go there. There is a nice widget there to get a quote from us. Immediately, someone will contact you back. If you need to contact me, this is my email. Probably will share to all the participants also the contacts as well. Feel free to ask any question. We have a decent amount of people that are experts in different areas of management, of realty, and we'll be able to provide whatever advice we can. Look, we certainly believe that this is the right way to make money for your future, to save for your retirements. And we think instead of like, we want to invest a lot in education. We are investing a lot in education around that. And part of that, even if you become our clients or not, that's part of our mission to make people financially independent through the real estate wealth.
I agree, and that's the reason why Daniel is hosting here, so we can share his knowledge, and like any other expert that we host, so we can give the foreign nationals more insights on the market, where to find a good business, how to manage a good business, and how to create this generational wealth from our end to our kids and grandsons and going forward. So thank you very much, Daniel, for your time. Thank you, everybody, for joining us.
Thank you.
And we're looking forward to making deals with you guys.